Hello traders, you are welcome to this video and you are welcome back to the Forex Geek channel. If you are looking to sharpen your Forex trading skills and navigate market trends like a pro, then you have landed in the right place. So in this video, we are going to be looking at a fascinating market phenomenon known as the Hindenburg Omen. Okay? Now this term may sound a bit dramatic. After all, it draws its name from one of the most infamous airship disasters in history. But what it signifies in the financial world is just as impactful. Okay, so what exactly is the Hindenburg Omen? In simple terms, it's a technical analysis pattern that suggests a potential market downturn. It's not just a random name, okay? It's derived from the catastrophic failure of the Hindenburg airship back in 1937, which is a poignant metaphor for market collapses. So to break it down, the Hindenburg Omen is triggered by a combination of specific conditions in the stock market. When these conditions occur, they signal an increased likelihood of a stock market crash. So why should we care? Because understanding this omen can provide us with critical insights that might help us protect our investments in the Forex market. Now let us discuss the key components that constitute the Hindenburg Omen. Okay, there are 5 essential criteria to identify it. Now the first is a new 52-week high. Okay, the first condition requires that the market has reached a new high in the last year. Okay, now this indicates some level of bullish sentiment in the market. Then secondly, a new 52-week low. So there must also be at least a certain number of stocks reaching new lows. All right. This juxtaposition of highs and lows is what makes the omen particularly interesting. Okay, so while we have some stocks reaching new highs within the last year, there should also be a certain number of stocks reaching new lows. Okay, now this juxtaposition makes the omen interesting. Then thirdly, there should be declining market volume. Declining market volume. The third condition is that the market's volume should be declining. This can indicate waning interest in the stocks at those new highs. Okay, and then fourthly, the breadth of the market. We also need to see that the number of advancing stocks is less than the number of declining stocks. All right, this disparity signals underlying weakness despite the market reaching new highs. Okay, now the fifth component is the total number of new highs and lows. So there has to be a specific ratio of the new highs to new lows. All right, the traditional rule is that for every new high there should be at least 2 new lows to trigger the Hindenburg Omen. Okay, now when these criteria align, it can serve as a warning signal for traders. Historically, whenever the Hindenburg Omen has appeared, it has been followed by significant market declines. Though it is important to note that not every instance leads to a crash. Okay, in as much as this omen can lead to a stock market crash or can lead to significant declines, yes, it does not necessarily mean that each time that we see these warnings that there's going to be a crash. Okay, it doesn't necessarily mean that. It's more of a cautionary signal urging traders to analyze market conditions closely. All right, now let's take a look at some historical instances when the Hindenburg Omen was observed. One notable case occurred in 1987, just before the infamous Black Monday, when the stock market crashed. At that time, many traders had seen the Hindenburg Omen, but it was often overlooked. Now, this underscores the importance of being aware of these signals and not dismissing them. Another example is from 2008, right before the financial crisis. Traders who were aware of the Hindenburg Omen may have been better positioned to mitigate their losses. It's this historical context that illustrates the potential significance of the omen in our trading strategies. So, how can you apply the Hindenburg Omen to your trading strategies? First and foremost, it's vital to combine it with other indicators and analysis, all right? Because relying solely on the Hindenburg Omen might lead to premature decisions, okay? And you wouldn't want that, right? You wouldn't want that. So instead, you should consider it as one piece of a larger puzzle. You might want to couple it with other technical analysis tools such as moving averages or RSI, which is the relative strength index, in order to gain a more comprehensive view of market conditions. All right. Now, this holistic approach will help you make more informed decisions about when to enter or exit a trade. All right. Now, before we wrap up this video, let's quickly recap what we have learned today. Okay, so the Hindenburg Omen is a valuable market signal that can alert traders to potential downturns. All right, it consists of 5 key criteria, including new highs and lows, declining market volume, and the breadth of the market. Historical occurrences of the omen have preceded significant market declines, making it a crucial tool in your trading toolkit. All right. As always, if you found this video helpful, don't forget to hit that like button. It really helps the channel grow and allows us to continue bringing you valuable content. Also, make sure to subscribe if you haven't already, okay? So you won't miss out on our upcoming videos packed with insights and strategies to enhance your trading skills, okay? The Forex Geek channel is one channel that provides a lot of valuable information cutting across indicators, strategies, different trading related terminologies, reviews of, Forex or trading related platforms. So there are a whole lot of benefits, right? If you subscribe to the Forex Geek channel, okay? Thank you for tuning in today. Remember, knowledge is power, especially in the fast-paced world of Forex trading. Keep learning, stay informed, and I'll see you in the next video.